let's talk about adjusting entries. Adjusting entries, by adjusting entries, I mean adjusting journal entries. These typically have to be made by a company at the end of the month, end of the quarter, certainly at the end of the year, to adjust some of the accounts. Notice that the actual adjusting entries that are prepared will never involve cash. Let's look at some examples. If they are classified as a deferred revenue or expense, the original entry did involve cash. That's the original entry, the original one, not the adjusting entry that you're about to prepare. Cash received in advance for an expense is called prepaid expense. It is an asset account. This might be a prepaid insurance, prepaid rent. That account is an asset for the company. So you would have debited that account. You see I have an example here on the screen, $1,000. Cash was expended, so we credit the cash account. Now notice all of these examples will follow our rules for debit and credit increases and decreases. The adjusting entry now, some of that prepaid expense would have expired, been used up, and so now we will actually recognize it as an expense by debiting the expense account, and then we will credit, which will decrease the prepaid asset expense account. Notice some accounts will pair up together. For instance, if you have prepaid rent expense, it will correspond to the rent expense account. So in this case, you would have prepaid rent expense, credit cash, and then at the end of the period, you're recognizing rent expense, and you're going to decrease the prepaid expense. Second example here is cash received in advance for a revenue. We call that unearned revenue. It is a liability account. Examples of this type of account might include, think of yourself. If you're going to a concert, you might have to purchase that ticket in advance. The star or performer you're going to go see has not earned that money yet. So they have to classify it as unearned revenue until they actually perform at the concert. Now they've earned it. Or think of an airplane ticket. If you're going to fly across country, you purchase your ticket in advance. The airline perhaps gets that money, but they haven't earned it yet until they fly you across country. Now they've earned it. This happens with all kinds of businesses. So some cash would have been received in advance. So we debit the cash. And then the unearned revenue, which is not a revenue yet, it is a liability account, would have increased with a credit to that account. Now at the end of the period, you're going to look and see, did the company actually earn some of that revenue now? And if they did, you would make the entry you see on the screen here for number 2. Unearned revenue would be decreased with a credit to that account. In this case, I'd just say $500. And the actual earned revenue now would be increased with a credit to that account. So we're decreasing earned revenue because some has been earned, and we're increasing the properly earned revenue. Next, if your items are classified as accrued revenue or expenses, there was no original journal entry. These are just some items that you're going to recognize now. So no original journal entry, no cash past hands in the beginning. Now it's just time to look and see what do we need to do. So first we have the accruing of revenue. To accrue means we're going to write it down. We're going to prepare the journal entry. We're going to record it in the books. So the way we would do that, now this is when invoices are being sent out. So we need to record accounts receivable, and then the revenue would be recognized as a credit to the revenue. This is earned revenue. Accruing expenses, this means that the company has incurred, they do owe some expense, but they perhaps have not paid it yet. So I just chose the example of wages expense. Wages expense would increase with the debit, and then it is going to correspond to an account called wages payable, which is also going to increase with a credit to that account. Again, go back to your debit and credit rules, and you'll see that these increases and decreases follow along in the same way that you've been taught in your class. To accrue an expense, no journal entry. Okay, let's look at some examples. Okay, the first one I want to look at is pretty simple. This is your depreciation expense. So in a problem in your textbook or your homework or even on an exam, you might be given this scenario. Depreciation expense for the period is $520. Okay, let's continue on now with our depreciation expense. So in this scenario, you're just given the amount as $520. So you do not have to make any type of calculation. Later videos will show you different methods for calculating this amount. However, now you're just given the amount, so all you have to do is make the proper journal entry. So to record this amount is to prepare the journal entry. You debit depreciation expense for this amount, and then you will credit the accumulated depreciation account. So remember that accumulated depreciation is a contra asset account. It increases on the right-hand side of the account. Each accumulated depreciation account will pair up alongside an asset account. For instance, building will have an accumulated depreciation account. If you have equipment, if you have machinery, if you have vehicles, all of those are long-lived assets. They are going to have a longer life than a year, so we classify them differently. Each of them that you are recording depreciation expense on will have its own accumulated depreciation account as well. Land, remember, is never depreciated, so you will not have one for land. So just to make this entry depreciation expense, you're given the amount, you record depreciation expense and accumulated depreciation. Remember, the debit section always goes first. Okay, here is scenario 2. So here we have office supplies at the beginning of the period with a balance of $1,500. During the month, an additional $800 was purchased. A physical count now reveals that $500 in supplies are still in inventory, so that's in the cabinets or in the closet. So I thought with this one it might be helpful to actually draw up the account with a T account to remind us of what this might look like. So remember, a T account is just a tool for us. And these are the office supplies, the asset account. They have not been expensed yet. Some have been used up, and so that's what we want to do, is expense them. So we have to make some calculations. Remember that debit is on the left, credit is on the right. The supplies, the asset account, just reminding you, increases on the left side of the account, so therefore it's going to decrease on the right. So let's put in the numbers they give us. So $1,500 was the beginning balance. I'm just going to designate that as BB. And then we had some purchases through the year of $800. And now they tell us that there is a end balance. So I'm going to call this EB. That's ending balance, $500. So this is what we need to know. How many supplies were used up? So we can just get your calculator out, or I'm going to go over here on the side and just write this up. So I have $2,300 worth of supplies to account for. Well, I know that $500 are still in that closet or that cabinet. So $1,800 in materials, supplies, had to have been used up. So the debit is to office supplies, the expense account, and the credit will be to office supplies, the asset account. So where I have this question mark here, let's see if I can get this eraser up pretty quick. So now after making that entry, the journal entry, this is what it looks like. So you get out your calculator, check it, make sure that it's correct, and all is well. Now let's look at a different scenario. So that's when you're not given the amount, but you're given a lot of details related to the supplies account. Okay, I wanted to clean that up a little bit so you can see this different scenario. So this is just a different scenario related to the office supplies. Here, office supplies had a beginning balance of $1,500. During the month, an additional $800 in supplies was purchased, and now they tell us that $650 in supplies were used during the period. So again, this is just a different scenario, and I didn't use all of the same numbers, so don't be concerned that it's not $800. They specifically tell us that $650 in case. I've just highlighted number 3 so that you can see the difference in these two problems. So here we're told that the office supplies, the beginning amount, the amount that was purchased, and then how many are still left. So we had to kind of go backwards to find out how many were used in item number 2. And in item 3, they actually tell us what that balance is, or what that amount was that was used up. So what is the balance in this case? Let's get that calculated too. So we had 1,500. Remember, two different problems. They're not supposed to come up the same. I just selected different numbers. So $650 were used up this period. So it looks like that balance would be $1,650. Okay? Notice the way that your problems are worded. Let's look at an example now of a prepaid expense. Remember that prepaid expense is actually an asset for the company. This is an expense that has been paid in advance but has not been used up yet. So for this one, number 4, we have $3,600 was paid in advance or prepaid for 12 months of rent on January the 1st of whatever year. 1 month of expense, rent expense, has now expired. So I put just the original entry up here so you can just kind of grasp what this would have looked like. So prepaid expense, the rent expense would have been an asset. It would have been debited for the $3,600, and then cash would have been credited. So a check or something would have been paid out. So a credit to the cash. Now we need to make the adjusting entry, which you see over on the right-hand side. And so we will debit now rent expense for some amount we're about to calculate, and then we are going to credit that prepaid expense account. Okay, so to get that, we can actually use Excel since I'm in Excel. So we have $3,600 total, and it is for 12 months of rent. So notice in the formula bar and on the screen, I'm going to say equals the $3,600 divided by 12 months. So that means $300 for each month, right? So $300 per month, and then we're told that only 1 month has expired. So we're going to record rent expense $300, and we're going to decrease the prepaid rent by the same $300. So that would be your adjusting entry to make for this type of scenario. Okay, now let's look at an example of unearned revenue. So for this scenario, $6,000 in unearned revenue was received on April the 1st. So at that time, the original entry you see on the screen would have been $6,000 debit to cash and a credit to unearned revenue for $6,000. Now this period, $2,000 has been earned. So the way that you would recognize that adjusting entry would be to record unearned revenue with a debit of the $2,000. And then credit the actual revenue for $2,000. So now you are recognizing some revenue earned, and this is decreasing the amount of unearned revenue. So again, we didn't have to make any calculations. The numbers were just given to us, so we just have to record the adjusting journal entry with the numbers we're given. Here we have another prepaid account, but because this one is a little confusing to students sometimes, so I thought it was worthy of looking at another example of this one. Okay, here we have that insurance premium of $4,200 was paid on January the 1st, and this is for a 12-month policy. Now 1 month of insurance has expired, and if you were told, perhaps they forgot to make this entry last month, you might have to record more than 1 month. But let's see how this would look. So the original entry would have been the prepaid insurance, and let's get that spelled correctly. Prepaid insurance account, which is an asset, and then cash would have been credited for the $4,200. Now we're ready to make this entry, so let's use Excel and calculate. You see up at the top in the formula bar there, I just put equals the $4,200 divided by 12 months, and I get $350. So now the adjusting entry is record insurance expense with a debit, $350. Prepaid insurance expense, that's our asset account now. And I intentionally threw this expense in there for you, not to confuse you, but so that you can start to understand what the real difference is. This is the asset account. So now we're going to credit that asset account for the same $350. Again, it's just like the one we saw a few minutes ago with rent, but I wanted to throw some insurance out there for you too to show you it works the exact same way. Let's look now at at an entry that needs to be accrued. So in this scenario, $2,000 is owed to employees for wages that have been accrued during the last 3 days of the period. So this is an expense that has been incurred, and now we need to record that. This is an accrual, so we need to record that with an adjusting entry. There was no original journal entry in this case. So what we need to do, we've already been given the number, so we don't have to make a calculation. We simply debit wages expense, credit wages payable. Note those two go together, wage expense and wages payable in this case. Here we have another example of an accrual that needs to take place. So here we have $2,900 in consulting fees have been earned, but the customer, Delmore Duds, has not been paid, has not been invoiced this period. So we need to debit accounts receivable for that $2,900, and then we will credit the revenue account. Perhaps it would be called sales revenue. Whatever the company calls it, that's what you would call it. So debit accounts receivable, credit the revenue account, and notice in this case there would not have been an original journal entry to contend with. Okay, we have one more scenario here. Interest expense incurred for this period, $260. Again, there is no original journal entry to contend with. We only need to record this expense that has been incurred. We need to accrue it, write it down, record it. So the adjusting entry would be interest expense, debit, $260. Interest payable would credit for $260. Okay, no calculation. I thought that it might be good just to remind you or introduce you to the calculation for interest, though. So this next scenario is the same type of problem. We need to accrue or record this interest, but in this case you have to calculate the interest. So here we have interest on a $10,000 note has not been recorded. The note was signed on October 1st of the current year with an appropriate interest rate of 8% to be charged. And now we can assume that we are at December 31st, so end of the year. I stopped to add a notation that the current day is December 31st so that you'll know how much time has passed. So your formula to calculate interest is on the left, principal times the interest rate times time. So when you're given an interest rate, it's generally quoted as an annual rate. So if you borrowed that money or a company borrowed that money the full year, then that would be the amount you would calculate for that year with just the interest rate. But in this case, they signed the note on October the 1st, and now it is December 31st. So the whole month of October, November, and December comes into play for this calculation. So you would say $10,000, which is the principal, times 0.08, which is your interest rate, and then times 3 and divide by 12. Now, if you understand that 3 divided by 12 is 1/4, use that. If you also understand that it's 25%, so 0.25, use that. I usually will go the long way around showing you things and then encourage you to take any shortcuts that you understand as you see them, and again you understand them and feel comfortable using them. So principal times interest rate times time in this case works out to be 200. And if of course you use Excel, notice up in the formula bar, the formula is up there for you. Equals parenthesis 10,000 times 0.08, close parenthesis, and then multiply times, in parenthesis, 3 divided by 12, close parenthesis. Excel's a marvelous tool. It'll do a lot for you if you'll allow it to. The adjusting journal entry would be the same as before. Interest expense gets the debit. Interest payable